Hey everyone, it's Paul with the Bold Profits for this Tuesday. So I was on Twitter the other day and I had someone write me and say, "Hey Paul, can you please explain the rules of the game?" And he was specifically asking about rule number 3 and rule number 4. And sometimes I've referred to rules of the game in my YouTube videos. However, I felt like, let me just do a video and cover this and even give you a little bit of an explanation as to what this is, why this is, how I came about it. Because many folks are new at investing and many people start investing with very little thought as to how they are actually going to do it. And it's a little bit like going to drive a car without knowing how to drive. You need to know how to drive the car so that you can successfully and properly and safely drive a car. And the stock market is a little bit like that. The stock market does require a certain level of understanding, knowledge, even practice of how to use it. Otherwise, it can be a very risky, dangerous place, no different than if you got into a car and just hit the accelerator and now you're at 90 miles an hour, you have no idea what the brake is or where the brake is. Suddenly you hit that and now you're in an accident. Now you've got all these problems. And the stock market in some ways can be that. And I believe many people actually go about doing exactly that. In other words, they find out about a stock and then the first thing they go to do is go buy it, and they take probably all of the money they probably have for investing or speculating or trading, whatever it is, and they'll put it all into one stock. And they'll do it all in one day, in one trade, and then they will sit there clicking the refresh button on their account, wondering to see if it goes up and down. And now they start to build a certain anxiety cycle of simply watching this one stock. On days that it's up, they're happy. On days that it's down, they're unhappy. And of course, many times the stock has often come from a tip, from a relative, from a friend. Often they know nothing about it. They've done no research. They have no background in terms of understanding whether this stock, this company is a good pick, whether it makes sense as an investment, which is completely different than a speculation, which is completely different than a trade. And I'm going to skip out on all that. However, I'll do a different video on the difference between a speculation and an investment, a speculation, and a trade another time. But today I'm going to stick to rules of the game and just tell you that before you go in and do what I mentioned, which is take this one stock, go all in with all of your money in one single trade, all in one shot, and start that anxiety cycle of just refreshing your phone, refreshing your computer, watching it. I'm going to put this graphic up, the rules of the game that we came up with our team came up with. And the rule number 1 gets to that first point, which is never make an all-in bet on any single stock. I'm going to repeat that. Never make an all-in bet on any single stock. So what does that mean? So someone tells you to buy any stock. It could be Apple, could be Tesla, could be Google, could be Amazon, could be anything, could be some penny stock that is very, very unknown, very, very illiquid, potentially very, very risky. And you are now going to take whatever it is, your $100, $500, $1,000, $5,000, and pile in. Now, you've gotten in, and now you're doing that anxiety thing of refreshing your phone, refreshing your computer. And one day you wake up and some piece of news is out. The stock is quoted down 30 or 40%. And suddenly now you're in a panic because you put all of your money in. Your $5,000 now is worth a lot less. And because you know so little about the stock to begin with, you have no real understanding whether this is something you should sit through, ride through, or if this is a moment where you should simply cut your losses and move on. And depending on how much risk you're willing to tolerate, how much money, additional money you have, how much knowledge you think you understand, you'll choose various different things. Now, the alternative to this is to have a portfolio. And this is the alternative to this going all in. In other words, I tell my readers in Profits Unlimited, which is my flagship newsletter, to buy a minimum of 5 stocks. And 5 stocks gives you a shot at 5 different companies, 5 different sets of price movements. It reduces the general up and down experience that you're going to have now when you refresh your portfolio, because there's 5 different movements, and each stock generally is going to move at a slightly different rate. One day, one stock may be down, another stock will be up. So on any given day, you're going to see a lot less up and downness, which people call volatility. I prefer up and downness because that's more clear. Volatility is always like a big word. However, what it means is when your account moves around, now you've got 5 stocks, and that reduces the amount of up and downness that you are going to experience, which is less anxiety for you. In addition to that, by having 5 stocks, you are giving yourself 5 chances to win. 5 chances to win. Many people call that diversification. However, diversification to me is this very eat your vegetables kind of word. And I prefer to think of it as giving yourself 5 chances to win. And when you put more stocks into your portfolio, you're giving yourself more chances to win. Instead of when you go all in and you buy 1 stock, now you're giving yourself only 1 chance to win. And if you are wrong, you could lose a lot of money. Now, the other way, if you have 5 stocks in your portfolio, if you're wrong about 1 stock, you might lose there a small amount of money, but you still could be right about the other 4. Even if you're wrong about 2 stocks, you could make so much money on the remaining 3 that whatever happens with the 2 stocks, it is more than made up for by what happens with the other 3. And here's a great example of it, which is that I put out this portfolio called Stuff quite some time ago. And Stuff is Spotify, which is the music streaming service, Tesla, which is the car, energy, battery company, Uber, which is a logistics, transportation, autonomy company, and finally Facebook. And you can see here, I'll just put up the results of Stuff. You can see that even if all the other 3, other than Tesla, had gone down, you would have made money in this sort of mini portfolio. And yes, I know that Stuff does not have 5 stocks. Nonetheless, the idea I was trying to do was to get 4 stocks in and sort of make an acronym that was memorable. I accept that it doesn't have 5 stocks. Nonetheless, my point is that by taking 4 chances, you gave yourself a much better shot at making money. Now, in this case, the return on Tesla is so out of control and so insanely crazy high that it's, even though there's others, even though Spotify has gone up and Facebook has gone up a lot, Uber has gone down a little bit, you're still making a lot of money by giving yourself many chances to win. And I would tell you that's rule number 1. In other words, never make an all-in bet. Instead, go with a portfolio. And you will have less volatility. You will have more chances to win and a greater shot at potentially winning very big returns. Because if you skipped out on Tesla and just bought the STU, Spotify, if you just bought Spotify, Facebook, and Uber, now you're missing the biggest part of your return. So that's a great example of giving yourself many chances to win. Now, the second one is related to the first one in the sense that many people also buy in all at once. And what does that mean? In other words, they take the money that they have and they spend it all, invest or buy all in one shot, in one trade all together. Now, many people would say, well, Paul, I lack the time. When there used to be brokerage commissions, people used to complain that it was expensive. However, I would tell you that when you go to buy your 5 stocks in your portfolio, you should buy them over time. In other words, buy a little bit today, buy a little bit maybe tomorrow, buy a little bit next week, buy a little bit the week after. If you have a very large portfolio, maybe you've got tens of thousands, maybe hundreds of thousands of dollars, you may need to buy over several months. And why is this important? Well, go back and simply look at the price of any stock in 2020 alone. Heck, you could look at the price of many stocks this week alone, and what you will see is up, down, down, up, down, up, down, up, down. In other words, the likelihood of you pinpointing a perfect day to buy is something that is very, very, very unlikely. Instead, you want to put yourself in the position to take advantage of this up, down, which sometimes can be very large. Just remember, in March of this year, we had virtually every stock in our portfolio go down by a minimum of 25, 30%. Some even went down by 50%. Now, if you had this approach and you were building your portfolio in 2020, if you even kept some of your money around and you were able to buy some of the very low prices in March, now you're seeing huge gains for at least a small part of your portfolio. So by breaking your buying up into small slugs, as I call it, small slugs being small amounts, and breaking it out over time, you get a chance to take advantage of the natural ups and downs that are there for every single stock. No stock is going to give you some perfect ride like this. Even though sometimes you can have big spikes that there, nonetheless, there's always a reaction. There's often where big sellers come and they push the price down, and now you get an opportunity to buy your stock at cheaper prices. The other thing about breaking up your buying into lots of small pieces is that you now can feel like you are in control, that you are taking advantage of lower prices, being opportunistic, instead of feeling a little bit like you've been victimized by the up and downness, the volatility that is inherent in all stock markets. And in truth, actually, any prices, there's always movements up and down. You go to any market of any kind, there's always movements up and down. Now, the third thing that's in the rules of the game addresses the all-in part of it, which is that if you're going to put 5 stocks into your portfolio, how much should you put into each? Now, I came up with this equal weighting by dollar amount. Again, I'm going to repeat that. So equal weight by dollar amount. So by that, I mean, like, let's say you have $500 and you're buying 5 stocks, you put $100 into each. Or you have $5,000, you're going to put $1,000 into each. And that's called equal weighting, meaning you're putting the same amount into each stock. And here's the benefit of that, which is that no one really can tell which stock is going to go up the most, which stock is going to go up the fastest, or you never know for sure which one is a certain winner or which one is a certain loser. Sometimes the stocks that you expect the least to go up can go up the most. And so by taking away some of the sort of emotion by which many people tend to allocate money in terms of market, by equal weighting it, you give yourself a chance to really be in stocks that can go up a lot, even though you may have disliked it. Many people, just going back to my stuff example, may have thought that Tesla was never going to go up. Nonetheless, that's the one that went up. And maybe in the future, it's a different stock. Maybe it's Uber that goes up. By equal weighting it into each of the stocks, you're giving each of these companies a chance to make you rich. And as I like to say, you want every single stock in your portfolio to give you the shot at getting rich. However, no single stock in your portfolio should really be such a big allocation that it can make you poor. So that's one of the rules of the game, which is equal weight your stocks by dollar amount. And then I would tell you, just let it be over time. In other words, once you allocate at cost, as long as you no longer need the money, you can allow it to be. And now what you will find is that the better companies, the stocks that are really things that people want to buy, they will come to bid it up. And now those stocks will continue to rise. So that's another rule of the game. All right, so we've covered three of the rules of the game. Now here's the fourth. Inevitably, readers often ask me and say, Paul, so one of my stocks has gone up so much, what should I do? Or I'm seeing profits in these stocks. What should I do? Now, many people try to time when they sell for the very peak of the peak. And I would tell you that to take on the philosophy that I would recommend, in other words, try and think of the stock market as something that you can use to generate money for your life, whether it be for your retirement, whether it be to raise funds for college or for any kind of expenses to pay off debt. Um, you want to use the stock market to get wealth so that you can make your life easier. I have always believed that the stock market is a means to an end to a better life, and that's the way I have used it, and that's how it's been most useful to me, versus the approach that you want the absolute peak point. You want to be all in all the time until the very peak of the market. And I would tell you that's a very risky strategy, because no one is ever going to time this absolutely perfectly. And in the meantime, there are many opportunities to sell where you can make quite a lot of money relative to the amount of money you have put in, which is why I would tell you that you want to sell on the way up. In other words, pay things off that you need to pay. There are things that you want in your life that would make your life better. Sell a little bit of the stocks that are rising. Make sure to never sell stocks completely out, because the stocks that are going up are the most likely to continue going up because they have an audience on Wall Street. People like buying the stock. There's something about this business that is driving the demand for the stock. There's growth in their business. The stock is still scarce. And so as people come to buy, they continue to bid it up. So the idea here is to just take a little bit off. Maybe if you own 100 shares, you might sell 10 of those shares, or 20 or 30 relative to your needs, and only you can know what they are. Nonetheless, the idea is to sell as stocks are starting to rise up, and then use that cash for your needs. And one of the needs that I would tell you, which is the fifth rule of the game, the final rule of the game, is to keep a reserve of cash in your brokerage account, in your investment account, in your actual stock account. So let's say you have an account at TD Ameritrade or Fidelity or Robinhood, wherever it is, leave cash in that account. And I like to tell my readers that for the vast majority of people, the amount of cash to keep is between 10 and 30%. And here's the purpose behind that. Stock markets have big ups and big downs. In March of this year, we had a genuine crash. Markets in the space of 3 weeks went down by the S&P 500, which many people refer to as the market, went down by 30%. However, I can tell you that individual stocks in our portfolios went down by as much as 40 or 50%. So when that happens, it becomes quite hard to simply stay in your stocks and to stay in there. You need some emotional comfort. And I say, if you have cash sitting in your investment account, in your stock account, in your brokerage account, now when this kind of volatility hits you, you can look at that cash position and say, hey, I've got cash and I'm okay. If these companies are still good, I can still continue to hold it. And you can use that cash as your volatility buffer, as your emotional security blanket to get through those moments, which always will come. There are always crashes, sometimes in the market, sometimes with individual stocks, and you need something to get through that. And having that cash there also then allows you to make small allocations when prices are very low. If that is something that is okay by you, you can now take some of that cash and buy in. And a number of my readers actually did that in March, which is that they had kept anywhere between 10 and 30% in cash. And they went in and bought stocks like Tesla, which have then since risen so significantly that some of them are reporting gains of 1,000%. So That's the last rule of the game. Keep a cash reserve, which is your volatility buffer, your up and down buffer, your emotional security blanket in your investment account. That will help you stay through those incredible periods when everything in you is telling you sell, sell, get out, because there's a lot of emotion, there's a lot of fear during those periods of time, and it's very hard to do nothing during those periods. And having that cash will allow you to sit and allow you to calmly look at what is going on and consider what you should do. So those are the 5 rules of the game. And I will say on this, which is that the 10 to 30% is something that's just a general guideline for people that are in retirement, people who are significantly older. If you lack enough resources for your day-to-day expenses, perhaps that number might be much higher. Maybe it's 50%, maybe it's 70%. Whatever it is, ultimately, you have to decide what that number is relative to your needs and what is right for you. So just to review, here are the 5 rules of the game that I tell you in terms of how to operate in the stock market so that you can try and use the stock market really to benefit you, to make your life better, as a means to an end to a better life, as I like to say. And in the end, stocks, they're never going to hug you. They're never going to kiss you. There's no emotional benefit other than the benefit that they deliver. So that's really the driving goal behind ultimately creating these rules of the game. Again, so the 5 rules are: never make an all-in bet on any single stock. Buy your positions in over time. Equal weight. Take profits on the way up, and keep cash on the side. So that is, if you will, your operating manual for how you can go about operating in the stock market so as to use the market for your benefit. So if you like this video, please subscribe to this channel, give this video a thumbs up, and I'll have another video coming for you next week. Also want to plug our Bold Profits Daily e-letter, where my colleagues and I are writing about things like this and also about incredible investment opportunities. I'll have another one of these for you next week. Until then, this is Paul saying bye.